5 years ago in Silicon Valley, all you had to do was sneeze in a lift and you get 500,000 US funding. But truthfully, the US, specifically in Silicon Valley, they're sitting at the top of Maslow's hierarchy of needs, right? They're secure, they've got food, they've got a place to stay. If it all goes to hell, they can sleep on their mother's couch. In Africa, we have slightly a different viewpoint. Our risk appetite is quite reduced, and we see that specifically in the funding space. There was a big narrative in Africa 5, 6, 7, 8 years ago, well, we'll only fund you once you've started revenue generation. But that's not really what is going to give you the big returns, and it's certainly not going to make an entrepreneur feel safe to go and take that risk. And I think that's going to continue. And I think this is now going to bleed into the macro investment space, where businesses with really good fundamentals, good understanding of customer journey, and the ability to turn revenue on and scale it are going to continue to get funding. And I think some of the riskier, more early stage ventures are going to battle to a large degree to get funding rounds outside of seed.
Welcome, builders, to How Would You Build It? The podcast that dives deep into the dynamic world of startups and product creation right here in South Africa and Africa. This show is more than just interviews. Every week, we sit down with the brilliant minds to provide a masterclass for building digital products amidst the challenges and opportunities unique to our continent. From seasoned founders to dynamic product managers, we uncover the unique stories and strategies behind some of the most innovative digital products being built. So for all the aspiring founders and product builders out there, you'll discover that each episode is a wealth of practical wisdom and local and actionable insights. Make sure to subscribe or follow wherever you listen to our podcasts and connect with us on social media for even more content. Now, let's dive into today's episode. Welcome, builders, to another episode of How Would You Build It? It's episode 46, and I think the third one of 2024. And finally, Rainier's back from his holidays, decided to come join me on the show again. Rainier, welcome back.
I'm back. It's good to be back, Bobby. Tanned and everything. We're ready to go.
Yeah, exactly. Got our tan for the summer. And I'm pretty excited today. We got Tramayne. He's from 176. He's the CVO, and he's going to explain that to us now. But it's really good to have you on. Trey, do you want to introduce yourself to the audience?
Yeah, thanks so much. And it's really cool to be here. I think we as a studio have been following you guys as you've gone through your journey, and really excited by the content you're putting out for the ecosystem. So I'm Tramayne, or Trey. I look after Next 176's venture studio, which encapsulates really the investment and VC arm, as well as the venture studio, which is really our build piece. And I look after these two very interesting beasts, and we're trying to add value to the ecosystem as much as possible and amplify the ability for people to execute on their entrepreneurial dreams.
Yeah, it's super exciting. I talk to a lot of people about, I almost feel privileged that we work in this space because it's so exciting. There's so much opportunity around us. It's almost like there's too much opportunity, too little time. But
too little capital.
Oh gosh. So the thing is, and we've been doing the podcast for a while, and I know, Rainier, we've had a lot of conversations around the difference between accelerators and incubators and the rise of venture studios. Rainier, can you just tell us about that kind of experience? Because you've also been around the block watching this all transpire.
Yeah, no, look, incubators were the early days of business building outside of just people building businesses. And I was the first kind of formalized, let's take an idea and try and develop it a bit further. And then obviously Y Combinator, probably 20 odd years ago, popularized the Accelerator, which was really taking someone to a place of being investor ready much faster. And I love it. In the essence, the Y Combinator people were entrepreneurs. They looked at a supply and demand issue. They had an oversupply of VCs, and the demand wasn't met with startups that were investable. So they said, can we accelerate this thing and do it in 3 months? Now, that model has matured a bit. A lot of people have tried it all over the world. I don't think with very great success. And we're almost at the next frontier now, saying, okay, well, how do we further reduce risks in building businesses? And that's what I love about the venture studio model. And it's almost, I think the time for it is probably now. And I don't know if you agree, Tramayne.
No, absolutely. I think the de-risk piece is the most interesting. I think at a macro level, we're going through a lot of turmoil in the economy, and I'm talking globally, not necessarily South Africa. And so the desire for entrepreneurs to take massive amounts of risk has reduced. What the studio does is it allows that safe space for the creation of dreams, really, an entrepreneurial spirit, with a little bit of de-risking and backing from a big mother or a big father. So we think the incubators and the accelerators are still very important, but we think there's a gap for people to play in outside of that scope, slightly de-risked, but certainly with great hopes, great dreams, and passions to build.
Yeah. So I've worked in a venture studio myself, and I think one of the awesome things about being in that environment was the talent that I was surrounded by, because it's all about bringing all the people, the right skills around the table for the ventures. And I thoroughly enjoyed just having that exposure to, top engineers or top designers or, data, whatever it was. I thoroughly enjoyed that. I'm not sure if it's the same, or I'm sure it's the same at 176.
Yeah, absolutely. It's about balancing, building the team's very, very difficult because you've got these job titles in the studio, which is quite niche in South Africa. What the hell is a venture architect or a venture associate? And so it becomes quite a challenge to balance the team. But we've been very fortunate. We've got people in the team with experience across companies like Salesforce, Google, Talabat, Tencent. At the same time, we've got entrepreneurs who have actually exited, and we've got some entrepreneurs who have actually failed but have learned a massive amount and loved the experience. And it's about aligning those interesting viewpoints with really top tier talent so that we can shorten the learning curve of the entrepreneur. I think that's really the critical differential between a studio and going at it alone.
And I mean, Tramayne, funding, if we speak to South African founders, like they forever speak about how funding is an issue, there's not enough funding. But in a lot of those cases, like if you look at the underlying dynamics of the business, there are other reasons why they're struggling to raise.
Right.
And sometimes when they resolve those issues, then might not even need funding to begin with. So what are some of the biggest challenges you think founders face that's prohibiting them from raising or making progress?
Look, certainly the dynamic is interesting in Africa to start with, right? So I give this example, 5 years ago in Silicon Valley, all you had to do was sneeze in a lift and you get 500,000 US funding. But truthfully, the US, specifically in Silicon Valley, they're sitting at the top of Maslow's hierarchy of needs, right? They're secure, they've got food, they've got a place to stay. If it all goes to hell, they can sleep on their mother's couch. In Africa, we have slightly a different viewpoint. Our risk appetite is quite reduced, and we see that specifically in the funding space. There was a big narrative in Africa 5, 6, 7, 8 years ago, well, we'll only fund you once you've started revenue generation. But that's not really what is going to give you the big returns, and it's certainly not going to make an entrepreneur feel safe to go and take that risk. And I think that's going to continue. And I think this is now going to bleed into the macro investment space, where businesses with really good fundamentals, good understanding of customer journey, and the ability to turn revenue on and scale it are going to continue to get funding. And I think some of the riskier, more early stage ventures are going to battle to a large degree to get funding rounds outside of seed. So I think we're going to bring that we're going to collapse that value chain of when you can acquire funding even more in Africa now, as sort of the large VCs and their external funding sort of de-risk in the new macro market. And that's why we're quite bullish on the studio model as well, and quite bullish on our own VC capabilities that we're building now.
And look, I mean, establishing a scale business in South Africa is really expensive. I mean, Time Bank released a statement, I think it was a week ago, saying they're now profitable for the first time, or 1 month profitable after 5 years of operations. But I mean, they raised $260 million. And similarly, Rain, the mobile operator, they raised in the region of 1 billion rand. And I mean, then you see VC funds in South Africa announcing they're launching a 100 million rand fund. I'm like, I mean, that doesn't get you out of the bed of building a highly scalable, big, large company in South Africa. So, I mean, with these unicorn plays, is it a space for corporates to play in? Like, how do we get these businesses funded and build more businesses that can list on the JSE and provide thousands of jobs?
Yeah, I think the converse is also true, right? And it's something we challenge ourselves with at Next quite a lot. Well, certainly I do. Do you want to spend all your time building one unicorn, or do you really want to build 10, 20, 30, 100, 200 million rand businesses? And ask yourselves, can that bleed your impact broader? And that's the challenge we have with ourselves. And we think there's a space for an ecosystem where there's some incredible large businesses that may never be unicorn, but they're doing really good, sustainable work for upliftment, and at the same time are deeply profitable. I think this narrative of we've got to be the unicorn, we've got to push through, we've got to be the biggest business is slightly skewed by our vision, again, of casting ourselves west and casting ourselves to this startup and entrepreneurial narrative that this is the way. We watch the shows about how Google was started and Uber, but there's a lot of pride that can be extracted and a lot of value that can be extracted out of 50, 100 million rand businesses as well. Because if you look at the Time example and you look certainly at the Rain example, there were existing builders in there who had done it all previously. So that funding is really back on reputation and execution of the past. We're trying to play with the entrepreneurs who are building their first or second business, who are quite comfortable with this thing. It's a 200-300 million rand business, and we're quite comfortable with those returns as well, because how we build our studio means that we're quite cost efficient because of the nature of the studio itself. And so the returns and the IRRs on our investments are quite palatable to us, even at those numbers, not necessarily being ready to IPO on the stock exchange, which I think is a misnomer. I think most startups probably don't want to be on the JSE, just from a regulatory point of
Most
view.
companies.
I know listed companies that don't want to be there.
Yeah, exactly.
Trying to get out.
Exactly.
Which actually leads me, Tramayne, to the next question, which is around IPO and exits. Like in America, that's the VC payday, right? If you don't IPO, you're never gonna 100x your fund. So or even 10x for that matter. So in South Africa, what do exits look like? What is an attractive exit? And I think most importantly, where does one exit to?
Yeah, it's a very tricky question, that, and I think it is sort of one of the power players of being a corporate VC, right? Because we've got a natural distribution for an exit as long as it makes sense to our head office and corporate level. And I think beyond that, it's not just our natural exit to, in this case, Old Mutual, but it's also the natural exit to other corporates and being involved in businesses that we believe could help those corporates in their strategic plays. While it is not our core focus to always make sure that we, one, build for this, or two, invest for this, we certainly do feel slightly more comfortable knowing that that is an opportunity for us. We're currently negotiating an exit back into the group as it stands. So we'll get a lot of learnings from what it means to do that. We have another venture that we're about to exit via a partnership to a big global bank as well, where we combine our expertise and capital and de-risk ourselves from the 100% owner to sub-control. So we're spending a lot of time on this very question. I think it's very important is, what does exit look like? And what we've done strategically in December is to say, even when we invest our first check, or when we build our first line of code or business model, we're already talking about exit strategies and starting to ideate and sort of delineate what that looks like in order to do that. When I was at Tencent a few years ago and we started the WeChat fund, one of the things we found every startup was talking about was, I'm just going to build so Google acquires me, or I'm just going to build so Amazon acquires me. It's that sort of thinking and mindset to say, actually, exit is good, exit is great. And if you focus on what they've been exiting, in this old case, Google or Amazon, in terms of what they've been acquiring, you can start strategically pivoting and having conversations for that really early while you build. And I think that's really important for us. And I think it's really important for all entrepreneurs to start ideating on.
And Tramayne, I picked up on something there, which I think is a bit nuanced in your model compared to VCs. I mean, VC typically follow a fund structure, and the fund structure has a horizon of when they'd love returns, right? They need to give exits in a certain stage. And what I've heard some founders complain about is when that deadline looms, the conversation in the boardroom changes from, how's the business still, how can we sell this thing?
Yes.
Next, from what I understand, is doesn't follow necessarily a very strict traditional fund structure. So you're much more flexible in trying to find good deals for founders, right?
Absolutely. I mean, while we are set up as a fund, because we're still a corporate VC and because we still have the studio leg, we really want to be part of businesses that are scaling, growing, revenue generative. It's not about going to the next round and exiting. As an investment thesis, we don't exit until really the big players, and let's talk Series C, starts kicking in. Then our mandate shifts slightly to say, we don't meet that. What does that look like? And interestingly for us, that could also be just passing on the baton to our own PE funds and our own big green that have the to then manage slightly larger investment pieces. But truthfully, we want to be, as a studio and a VC, founder friendly, growth friendly, that trusted advisor. And I think South Africa really needs to focus on those pieces around when you're building your own businesses as well. How do you get, and not necessarily just saying next, but there are a lot of people who are really founder friendly and really willing to go out there and advise and grow and help build these narratives.
I think for me, what's interesting is, as a founder, right, that's got an idea and maybe some funding that can get that first MVP out the door. How does that conversation look when you're telling them that you have to think about your exit when they're just trying to, I don't know, get customers?
Yeah, it's a very interesting conversation, that I think for us, I think there's two modalities here, right? There's the investment and then the build. The build we have a lot more control over. As you can imagine, I can't talk to a 10% investee and say, look, what does the exit look like? I can obviously guide them if that is the entrepreneur's preference, and they say to me, I've got a good 7 years in me. I'm really going to push this. We can start guiding that. But on the build side, we have a lot more say in terms of that, because we have sort of more controlling equity. And I think that piece is just around saying, as a venture studio and what we build, we have a natural attrition. And sometimes that exit is allowing the founder to go with them. So if you leave the studio, you now become an investee to us. We reduce our control. There's increased founder equity. There's increased maybe third-party equity. And then it becomes a different modality as well. So I think it's also important to understand that in our world, you can also exit the studio, but Next 176 is still a strategic investor. And so it is balancing a really fine conversation point around, and I think this is one of our hybrid problems and opportunities, is that we do both.
And interestingly, I mean, there must be a lot of ideas that come out of the Old Mutual stable. Maybe you can share a bit around the benefits of working with a corporate. I mean, the obvious things are people go, cool, there's a customer base, there's some funding, there's some other things. But what are some of the other subtle benefits of doing this with a corporate?
Look, I think the interesting thing for us is twofold. The first thing is we're set up independently, but linked to the corporate. So we have this ability to be world-class at what a VC or a studio would look like, which in the traditional world, if you were inside the corporate, might get a little muddy. And the second thing for us is we have the ability to tap into people in Old Mutual who are trying to solve problems every single day, who are speaking to customers every single day across personal finance, whether it be insurance, whether it be retirement annuities, whether it be pension funds. We have experts on tap to go and speak to people who are actually following customer discovery processes anyway. And we then get to try and figure out, can we ideate on the fringe? What are the things that they need to be testing that we could be doing quicker through some of our build processes? And how do we ramp that up? So for instance, we built a product and we truly believe it should fit in the Old Mutual finance space. So we get on a call with the CEO and he guides us to say, if you do these 3 things, it would be very interesting to me.
That's
and
amazing.
So being able to have that back and forth and that ideation and that collaboration is really powerful, because to the point, if we start encapsulating their desires and pushes and customer requests from there, our exit becomes easier as well, right? I'm not trying to just sell a product back to Old Mutual that they've never heard of before. So that becomes also a very interesting balancing point for us. Also very, very difficult for us to sometimes bridge the gap between entrepreneurs who are super passionate about solving a problem that they're passionate about right now and what's going on as well in the corporate. And that balancing act is something we need to do very carefully.
But I love that point, Tramayne, because I think, or the previous point, because I think a lot of founders say when they do it the second time, instead of trying to sell to 5 customers, they'll sell 1 customer and work with that customer for 6 months to really learn the problem in and out and make sure it works really well and then move on. And with Old Mutual as a customer and some of the ventures you're building, I can imagine that could be super useful to get that inside track and really understand the problem well.
Absolutely. And I think the third thing that they give to us as well is actually just geographic scale, right? Introductions into Kenya. We've got offices in 13 countries. The ability to say, maybe this is not a South African problem we're solving, but we do believe it's a problem. Can we go test it in Kenya? How do we go test this in Accra or take it to Lagos? So we're really fortunate on that front as well, that We don't have to set up an office. We don't have to scale up a team. We can really just leverage our partners and our collaborators in the whole mutual stable across Africa, which is really, really helpful, because sometimes it just won't work here. But there could be massive opportunity elsewhere.
I want to move over into the building part of these ventures. And when people think about startups, they often think it's tech companies, right? They think it's all code and nothing at the back. But tech often helps businesses scale better and make it more cost effective. And mostly it just makes it more efficient than the incumbent. So in your venture studio, how much of the work you do is technical versus business strategy? Like, what does that composition look like?
Look, I think the easiest way to answer it is just at the composition of the team, right? We've got a team in the studio of really 2 people in tech and maybe 8 to 10 across the other spaces. And I think if we now delve deeper into what those other spaces are, that includes business modeling and really product development. My favorite people to hire are product people, because they understand how to go and get customers and to open up to them, to speak to them, to ideate with them. And so the team is really focused on research and desktop research to a start, and then deep in-field research around, are these the things we need to be solving or not? It's very easy to come up with a problem in your closed little world, wherever you're sitting, be it Joburg, Cape Town, Sandton, CBD, but the world's much larger than that. So can we hire people who are really good at that piece, with a particular mindset to understanding what's going on in the product space, what's going on in the business world in terms of problem solving across the globe, and being able to take a real hypothesis and take one of those big guesses and actually use scientific principles to prove it or disprove it. And once you prove it or disprove it, what is the next step? What is the next thing that we need to figure out? In order to succeed, what might we do? And start really from that point. So critical for us. I think you hit the nail on the head. I think tech's the tool. It's as much a tool as Excel is. If you don't use it effectively, it'll ruin you if you don't go and do the hard work around what you're trying to solve. So we spend a lot of time in that phase. Obviously, we touch technical feasibility during that hypothesis validation phase. You don't want to come up with something and then realize you can't build it at all. But certainly for us, our secret sauce is that validation layer, that hypothesis testing layer. That's really where the studio shines. And I think that plus the shared services is why studios can scale quite quickly. For instance, we're working on 5 startups right now, various stages of ideation to all the way to prototyping. And we've got a team of maybe 12, 13, because the services that we've overlaid are scalable. The frameworks are scalable. I often use the example, you'll find a founder who's excellent, maybe as a CTO style founder, excellent to the tech space. Maybe he's got a great relationship with a B2B customer that he really thinks he can sell into. But maybe the pivot to B2C or D2C, he has no idea about digital marketing. So we've got digital marketing expertise. But on the flip side, we've also got B2B expertise in our partnerships team. But on the flip side, we also have technical expertise. And so we try and shorten the learning curve of the founder to say, we know that not all founders have everything covered. It's, I don't even have everything covered. The studio doesn't even have everything covered. But we try and shorten that life cycle to say, we've done 5 prototypes in the last 3 months. We've done a lot. So if you want to come do your prototype, instead of doing 9 months worth of validation, hypothesis testing, and prototyping, we can do it in 12 weeks.
Yeah.
So that's really the pro.
Yeah, you speaking my language. So as a product person myself, as a product manager, I mean, it's music to my ears. It's exactly what we all want to do as product managers. We want to do that validation. We want to understand that we are building the right thing before we just go ahead and build it. And so it's fantastic. And to your points that you were making now, it also speaks to that talent pool that I was talking about at the beginning of our conversation. Is, when you have these sort of template approaches to validating an idea, it's the talented people you have around the table that can help you get there a lot quicker, instead of just constantly relearning school fees. You kind of fast track that. But my question is more around the founders, right? So in my experience, one of the toughest things as a product manager that wants to go and do all of this validation and research and all of that, the founders generally are very married to their ideas, and it's actually quite difficult to kind of get them to understand that, no, listen, you need to do a bit of this research, or they feel like they understand it, they want to drive it, and it kind of, they throttle the agency that your product and your builded people are allowed to have. So I just wanted to understand what your dynamic is like and your learnings from there.
No, I mean, absolutely. I think the one side of it is its passion and conviction, and the other side is framework and testing. I tell the team specifically, the framework exists so that Tramayne can never say, this is a good idea, go do it. And it's the same things when I interviewed just today someone who's interested in coming into venture architect space. It's the same narrative I give early on. Before you join, you must understand that the framework is there because in the absence of data, someone's opinion has to trump, and we don't want opinions in here. And I think that narrative has to be set early and upfront, because we say, this is the power of the studio, the frameworks and the reiteration and the constant reverting and constant checking of every assumption and every hypothesis. So we always lay that out. We say it's not supposed to slow you down. This is not something that is supposed to be tedious or cumbersome. It is to alleviate long tail frustration. It might be a little frustrating in the early stages. You might think you know what you want. It might be frustrating, but please bear with it because it has borne fruit. But really, we set that narrative early, and we set it at the top. If I walk into a meeting and say, this is an amazing signal, I think we should build this thing, anyone in my team who could say, cool, Tramayne, so where's your data point? Have you spoken to 5 customers? And I can go, there's my data point, I haven't spoken to 5 customers. And I'll say, let us know once you've done that. And it's to create that flow across the org, right? Across everything we're doing is culturally very important, but also really important for our potential successes in the future.
Yeah. So Tramayne, basically, Elon Musk cannot work for Next 176 because there's a framework.
Look, I think the problem with Elon is all the frameworks are in his head, right? So he's running them all and running all of the nuanced calcs in his head that none of us can compete with. But
them on the fly.
Yeah, truthfully, he's an outlier, right? If I could find someone like him, I'd say go without frameworks.
Create a venture studio within the venture studio.
Yeah, exactly. I would leave like my pirates over there to just go for conquer. But would love to tap into that brain one day. But certainly now the scientific approach is something we find works and we hold in high regard.
And speaking about founder age, I mean, research shows that most successful founders are not Zuckerberg or Elon Musk, say 40 to 45-year-olds.
Yeah.
How do you think venture studios can help these guys get going and build that startup, even though they might not be able to afford the level of risk that typically?
Yeah, and I think the level of risk is something we think about a lot. We think of the studio as this space where people's lives have fundamentally shifted, right? So I met a founder the other day. He's exited a business. Then he had 2 children. He really wants to do it again. He doesn't want to be stuck in corporate, but he realizes he's got to earn X number to get these 2 munchkins through university. So he wants to de-risk this time of his life, but he still has that fire and that burn inside of him. To your point, I think 39, I think he's 38, 39. So we really see the venture studios playing 2 roles. One, really growing young entrepreneurs in a de-risked way and amplifying them. So my thesis is if we get young entrepreneurs in and we teach them how to build, the likelihood that once they exit our ecosystem, they're going to go build something amazing. And they're going to build it in a really constructive and strong way. And maybe we play a part in funding them, or maybe we don't. But we do see that. And we start some of our programs. We're doing one now with Seed Stars. We start some of our programs with 18-year-olds, bringing them to the studio and letting them learn how to do these processes with us, because we have a long time horizon. But to your point, for us, in our mind, those entrepreneurs that have been to war, those entrepreneurs that have seen it before and their stage of life has shifted, we have a high confidence level in those individuals. And the studio is prime for that style of person. We want people who've been to war.
I think my experience being in a venture studio myself, what I loved the most about it, one of the things was, again, talking to the talent and the people, it's actually becomes a breeding ground for a mindset that gets created amongst everybody, right? So like you talk about iterating, doing research, whether it's desktop or user research or whatever it is, right? A lot of these concepts are actually foreign to your general entrepreneur. They're still figuring it out. They get married to the idea and whatever it is. And what I love about a venture studio is that you actually develop a very interesting culture within the company, because what you're doing is everyone that comes in, and my experience is especially the youngsters that come in, right? Because their minds are so easy to mold. it's not the teacher old dog new tricks. You're actually teaching these new young dogs the way it's meant to be, and the Y Combinator sort of mindset about iterating and all of that. And that it's not really a question, but just something that I've experienced personally is the breeding ground for innovation, because you're developing a mindset amongst the team. And so when a founder comes and plugs himself into that, the benefits are like the school fees again is just like minimized. That risk factor comes in because we've got a good foundation and we're molding the right mindset.
Yeah, absolutely. And I think we touch on a little bit of this, but Next 176 really has two goals, profit generation via these investments and builds, but certainly impact. And one of the OKRs we've adopted in my team, and my team's the investment and the studio encompassing the ventures, is amplifying Africa's talent. And that's why we have 15, 18-year-olds joining us in, I think, 2 or 3 weeks to join a program where we're saying there's 3 teams of 5, come up with a problem, we'll take you through the studio process. And if they exit or stay in the process is irrelevant, but they've learned a very valuable skill. And I think if we can teach people to build businesses in Africa, we alleviate a lot of our own problems. But on the flip side, you become quite hireable at a corporate too, in this new sort of burgeoning innovation space, digital and data space, because you have this design thinking, because you have this structured problem solving thinking. It's not just about forming businesses, it's about testing assumptions and problem solving as well, which is truthfully a lot more than most schools give you and most universities. We're really excited about the impact we can bring there as well. And obviously, selfishly, an amazing idea might come out of an 18-year-old living in an environment that's completely foreign to people in the studio. We don't know. But even if something doesn't, we know that someone in those 15 that join us is going to launch something of real impact if they stick it through.
And you know what the beauty is of the young people? I mean, I started a business when I was in my early 20s. It's the naivety. It's like you keep thinking, how hard can it be? So you try all of these things you would never try when you are battle hardened and had a few scars to prove it. And then sometimes some of these things stick, right? They work. And then there's a bit of progress. And I think what I love whenever I get to work with young people is to actually see that happen. I'm like, oh yeah, these things, random things sometimes do work. And it encourages me to try more things that
I think we get so stuck in our own experience, right? It's like, well, this thing hasn't worked here and it hasn't worked here, so it's probably not going to work here. Where the youngsters like, well, I've never done this before, and then they unlock something, And it's also the power of making sure you're not just acquiring talent from a single pool either, whether it be gender, racial, geography, employment experience, or even degree. We've got engineers, we've got PR people, we've got bloody chartered accountants like me who are useless at tech. We've got everything, but blending those opinions together is so important at the ideation stage, but also at the challenging the status quo stage, because you can't compete with an engineer's opinion on something because I don't have experience. All I can say is, have you thought about this? And then they say yes, no, or maybe. And I think that cultural nuance of a studio is also very important, because even if an entrepreneur comes in, there's no real CEO, really. It's still a team effort from the early onset
project,
and you lose that group think, and you're not just hiring all people that look like you or talk like you, and so it becomes an interesting little bedrock to build from.
Something else I experienced was it's also impossible for one alone to stay abreast of everything that's evolving. I mean, look how quickly AI is evolving. Look at blockchain and what it did. So to have a lot of these youngsters and just having that diversity of talent, they are actually doing the work for you, because you're allowing them that interest to go and explore that blockchain, let's say, and understand what you can use with it. You don't have to do it, but you've got this team that can stay abreast of what's relevant, what's evolving, whether it's new tech, new frameworks, you name it. And I thought that was also really cool.
Yeah, because I mean, you've got this younger generation, who've probably been investing in Bitcoin for 6 years, even if it's 200 Rand a month or whatever it is, but you've got a generation that spent time figuring out what Bitcoin is and has a light touch impact of maybe what the differential between Bitcoin and Ethereum is. And so you have people in these spaces interested in these different things, where we sit down and go, okay, cool, what are we going to do? If it's me and one other, what are we going to do with the blockchain, guys? What are we going to do with the blockchain? And you try and force the solution versus trying to just let the solution come to you via a variety of voices and opinions.
Love that. Tramayne, there's a lot of talk about VC funding drying up, a lot of talk about tech layoffs, a lot of talent hitting the market, no funding. What do you see happening in this startup space, specifically in South Africa over the next 5 years?
Look, I just think it's going to sort of dry up globally for a little while. I think if you look at the US market and the tech layoffs that really permeated last year, big numbers. I think you could take those as a proxy for things to come. They're seeing slightly earlier than we are. You know, if you're the CEO of one of the big US banks and you're doing layoffs, you start to think, okay, what does he know that the rest of us don't? So I think we're certainly going to go through a slightly drier patch. My answer to that is what we touched on it earlier is, as a business, you need to start focusing on what are the fundamentals. What are the core metrics that really drive your business? Understand them, understand how to scale them up and down. It's a lot easier to come and ask for funding when you say, if you give me 10 million Rand, I can acquire X number of customers, and I can show you that it's a relative term because I've done it already at a different ratio. And if I acquire those, let's call it 10,000 customers, I can convert them because I've already tested the conversion rate. And starting to understand the metrics of your business, whether it be a subscription business, whether it be a B2B upsell business, and then understanding your sales cycles and lead times, understanding the core things that make your business tick, and we sort of calling them and turning them into the fundamentals. I think there's still going to be capital for those businesses. It might just become slightly in different forms, and I think we'll sort of see a rise of debt equity a lot, permeates a lot more as risk comes off. We'll start to see different sort of convertible notes come to play. But really, I think there is still money in corporate, in PE, where those fundamentals are important, because people are going to start saying, I'm not taking a punt on Tramayne anymore and his network. I'm actually going to go to that unknown person who understands that his LTV to CAC ratio is 3-to-1. And if we scale this thing, we know we're going to make this amount of money. I think that's the shift we're going to start seeing. I don't think it's going to be all bad, truthfully. I think in the US, they had massive bubbles and balloons in terms of how they scale these businesses and they'll come to pop. I think South Africa's been a little bit more mindful. Not necessarily Africa. I think, we've seen a lot of pops in Nigeria. But I think South Africa's been living on it's hard to raise funds landscape for quite some time now. So I think it'll be a natural sort of transition to slightly higher ticket sizes in businesses that really have sorted out how to scale and what their fundamental problem-solving capabilities are.
That's interesting, Tramayne. I think we started to see some of the higher ticket sizes, right? So, it's in the past, it was news when someone raised like 10 million Rand. Now you're more regularly seeing a 50 million, 100 million.
Yeah.
It's less deals, but it's more, it's bigger checks. And I think that's definitely happening. And I do want to echo your point. I think, corporates, at the heart, they're business people. They want to do business and they want to see their businesses grow. So bring something forth which can help them do it. They've got a lot of profit on that bottom line that can go into investment that could increase that over time. So I think there's a massive opportunity.
And I think the opportunity is even further than that. I think one of the core problems corporates have when acquiring is, they've got a bunch of corporate investment types who look at the PE ratio of 15, 16 of a scale-up business and say it's way too expensive because they don't understand the scale-up. We're going to see a compression in valuation metrics. If we're not already seeing it, which we think we are to a degree, we're certainly going to see it in the next year. So for corporates, these investments become really reasonably priced now. Now sitting at more industry standard levels, not inflated by the market, not just popping the word blockchain and AI and pulling out a 20 PE ratio. And I think that is the opportunity, I would say, to corporates, back the industry, start getting interesting ideas into your business, but don't absorb them fully and don't corporatize them. I think this is also a stage, right? Let them grow, let them scale, let them tap your markets, your expertise, but certainly let them keep the essence of what has got them scaling already. But I think those collapsed valuation metrics are a massive opportunity, not just for corporates, but also for VCs to acquire some really top-class talent in their portfolios and top-class businesses.
And it opens up the investment space. Traditionally it would be VCs doing these insane valuations. I mean, I looked at a few asks the last few years, and I'm like, I don't even know if you're going to eat that in the US, let alone when you're speaking to a South African investor about this. People with R1 million a year revenue going, at a 50 multiple. It's like crazy.
Yeah,
Anyway,
listen.
so bringing that down, now all of a sudden you can get the PE guys interested because they're going, well, we're looking at fundamentals here, and this looks different. We all know South Africa has a really strong PE market. There's a lot of action in that space. But also corporates and also high net worth individuals, because now they're not
Absolutely.
investing in a high risk startup, they're investing in a
Cash generative business.
in a risky business that has a very high upside. And that's fundamentally two different things. Like, I mean,
Absolutely.
every single business out there has some level of risk associated to it. It's just what is the risk appetite for the potential upside that you can get. So I'm excited. I think we're going to see, VC kind of, I don't know if VC is going to go away, change. I think it's definitely going to change, probably not going to go away. But I do think we're going to see a whole lot of other players entering this traditional startup investment space, and which I think is exciting.
Yeah, and I think we started seeing it a couple of years ago in Southeast Asia. The rise of the CVC in Southeast Asia was quite prominent. It's not to say VCs disappeared, but it's a very different subset of what they're looking at, to your point. Some of those 10, 15, 20% investments from the big corporates are rounding errors on their balance sheets, to be honest, in the early stages. So that risk appetite can sort of flex up and down based on your own capital allocation. And so I think we'll mirror that to a degree. And I think there are a lot of commonalities in Southeast Asia and Africa in the medium to long term. But certainly, I don't think VCs are specifically going away. And also, I think there's a space where VCs and corporates can work together. And there's a lot of, I know founders don't always specifically like it, but I think we'll also start to see the rise of investment in kind from these big corporates. So let me promise you a distribution method with X number of upside, and you give me some equity for free. I think we'll see a lot of those negotiations happening, which is a very fair thing too, right? With maybe a follow-on in cash. So I think we'll start to see these interesting hybrids start to form as the market settles into this new world.
Love it.
Yeah, I'm also excited just listening to you guys. It's the way things are at the moment. So obviously with America, we had the ZERP and we had all that free money, and it's now evolved. And I think, I think South Africans and African startups actually have a head start, or they should mentally have a head start, because they've always had to work in these environments. So now everyone's actually have to catch up to us.
Absolutely.
Yeah. So Trey, we've come to the end, unfortunately. I could probably go make some more popcorn, come back and carry on listening to you guys, but we're going to wrap it up. And we always wrap up our episodes with a lightning round of questions for our guests. So how it works, I give you a question. You don't have a lot of time to think about it. Think about the first thing at the top of your mind and shoot. All right.
Perfect.
So, cool. So the first one, which is for me, building up a nice library. What book would you recommend for founders or people in this building space to read?
Extreme Ownership by Jocko Willink. I just think transformed, one, how I lead teams, but also two, how you start to unpack problem solving. I often use the example, if you're going to have a framework that's going to keep you alive in a war zone, why would it not work in your startup? And I think as you start to scale teams in particular and start dealing with the founder dynamic and the hiring piece, you want to hire people who have this drive to own, this drive to push. And the second really big principle that I love in the book that's really applicable to startups is the Navy SEALs design the box and you can play anywhere else in the box. So it gives you freedom through the discipline.
Okay.
And, we really love that construct for building businesses and running teams, and something that I found quite transformative.
Yeah, that's pretty cool. One of the founders for the early episodes of this year, she actually said she wants to hire someone that's been to the army. That's like her next hire. Maybe she read the same book. All right, cool. So the next one is, what piece of advice in your full career have you received that you believe a young 18, 19, 20-year-old coming into the space should you want to partner them with?
Look, for me, the most critical thing I learned through my career is the adaptability piece. I started as a boring accountant, sitting in a tech company, realizing that I wasn't adding the value I wanted to do, and I had to adapt myself. What that meant was learning, it was reading, it was consuming, it was asking for jobs, and being able to adapt to different environments, different products. And really, this was critical at Tencent when we had a very broad product stack. Being able to mitigate any risk through your adaptability will really amplify your learning. I think long gone are the days of the linear career trajectory or path, or I'm not, if you'd asked 18-year-old me if I was doing this, I wouldn't have actually even known what it was.
Very different time.
So modeling yourself to be adaptable and robust at adaptability, it can't drain you. It's got to be really, really something you thrive on. I speak to. It's just roll with the punches, be adaptable, just keep moving.
Be agile.
Yeah, absolutely.
So speaking of agile, what's your favorite productivity tool that you use, your go-to?
I really love using Pomodoro as a technique to get deep focused work. But for me personally, outside of my individual productivity, from a team productivity point of view, I adore Slack. I believe in complete transparent communication, so the whole team can see what's happening. But the second thing I love is I think there is a strength in writing your ideas and arguments down that make you really refine your thinking. If I ask you to have this conversation, Spitfire 5 minutes, and ask me to write the answers, the quality is going to be vastly different. And so we really adore using Slack in my teams to refine how we think about things, and how we write them down really drives the quality of what we're trying to produce.
Okay. I like that. Interesting. Two very quick ones. What tech trend do you think is going to win at the moment? So we've spoken AI and blockchain. Is there something that you believe that's going to take it this year?
Look, I think unfortunately for blockchain, I will say that it is unfortunately always directly linked to sentiment on Bitcoin, just because that's where it was birthed. And so that really is dependent on what happens with the Bitcoin price this year. We really see personally the trends of the troughs and peaks around that Bitcoin price, which is very unfortunate. Super powerful capabilities, really strong problem statements.
Needs to decorrelate. It needs to break away.
Absolutely. So I think, AI still really has the buzz. You see companies like NVIDIA hitting all-time highs now, Microsoft with the OpenAI acquisition, and then really reverse engineering the control of that business through the Sam Altman piece. We really think generative AI is still really where the play will be this year. We think it will move away from really what ChatGPT can do into things like Elon's Gronk being a little bit more real. And I think the art of the generative AI and where it'll amplify startups this year is actually people understanding how to use them. It's not necessarily just a tool that you can plug and play. We still think there's a massive moat around generative AI, and if you're using it effectively, you're going to beat 8 or 9 other people who are not using it at all.
Agreed.
We're just trying to figure out those use cases still. But I think they're coming, and they're coming fast, especially with building your own GPTs now.
Yeah. Okay, last question, very quickly. If you had a billboard, what would it say?
For myself?
Yeah.
It would just say, he tried. I think just the 2 words, he tried. I try everything. I experiment with everything. You can put it on my tombstone, not even my billboard. I'm comfortable.
Nice. Brilliant. I like that very much. We've come to the end. Trey, thank you so much for joining, Rainier. Any final goodbyes?
No, it was awesome. Thanks, Tramayne.
Yeah, I appreciate you guys. Thanks so much for having me.